Welcome to the Deep Dive. In these sessions, we sift through stacks of material articles, reports, call transcripts, like the ones you send us trying to pull out the really important stuff, give you a shortcut.
Exactly. Helping you get informed without wading through everything yourself.
So today we're diving into the SAIC Fiscal Year 2026 first quarter earnings call. Got the transcript right here. Our goal, help you understand what really matters from this call, what they reported, what it means for the business, the market.
Right. Earnings calls, they're dense. Right. Lots of info, lots of jargon. We'll try and cut through that for you.
Okay, let's jump right in. The quarter ended back on May 2nd, 2025. What were the headline numbers?
Sure. So revenue first came in at $1.877 billion. That's about 2% growth year over year. So, some growth, moderate growth to start the fiscal year.
Okay, 2% growth. And profitability, what did that look like?
Adjusted EBITDA, that was $157 million. Now, that works out to an 8.4% margin for the quarter.
8.4%. That sounds a bit lower than their usual target range, doesn't it?
It is, yeah. Definitely below the full year goal. We'll unpack why in a bit.
Got it. And how did that flow down to the bottom line, earnings per share?
Adjusted diluted EPS was on $1.92. And interestingly, that was actually flat compared to the same quarter last year.
Flat EPS, even with revenue growth and that margin change.
Yeah.
Okay.
Yeah, some moving parts there.
And the one everyone watches closely, free cash flow.
Yeah. That was negative $44 million for the quarter.
Oof. Negative $44 million.
Yeah, definitely a number that caught attention. Management spent a fair bit of time explaining that one on the call because, well, it's honestly quite different from their full year guidance.
Okay, so summing up the snapshot, modest growth, lower Q1 margin, flat EPS, and negative cash flow. Definitely a mixed bag to start. Let's dig deeper. That 2% revenue growth, what was behind that?
Well, management pointed mostly to the continued ramp up on programs, both new ones and existing ones. They specifically mentioned TCloud, IMDC2, and GMAs as, key drivers.
So work they've already won is really kicking into gear.
Exactly. And the growth from those programs was enough to offset revenue rolling off from contracts that finished up or were transitioning out. Shows they're managing that cycle, backfilling the work.
Makes sense.
Yeah.
Now let's get back to that margin. 8.4% adjusted EBITDA margin. You said it's lower than their full year target of 9.4% to 9.6%. Why the dip in Q1?
Right. So a couple of things. First, there's the typical seasonality. Q1 often sees higher investments kicking off the year, but they also specifically called out higher bid and proposal costs, B&P.
Okay. Spending more to win new work.
Yes, but interestingly, they said part of the reason B&P was higher was because of delays in government procurements. Awards are taking longer, so they have to spend on those bids for longer periods.
So delays on the government side are actually hitting their costs and margins directly.
Precisely. And then there was another issue. They mentioned higher costs on a specific fixed price program they have in their space business. That was another headwind in the quarter.
Got it. So seasonality, B&P costs may be inflated by procurement delays and a specific program issue. How do they expect to get back to that 9.4% to 9.6% range for the full year then?
They sounded pretty optimistic. On that space program, they got option extensions after the quarter ended, and it's moving into sustainment, which should help profitability. Plus, they mentioned they've put in place some internal execution initiatives to improve performance generally.
So fixing the specific problem and some broader operational tweaks.
Yeah, they actually quantified the Q1 headwind, said it was about 50 to 60 basis points drag on the full year margin, so 0.5% to 0.6%. They know they need to make that up, but they sounded confident, reiterated the full year guidance.
Okay, let's switch to earnings per share. $1.92 flat year over year. How did that happen with the revenue growth but lower Q1 EBITDA?
It was kind of a balancing act. The big helper was a lower share count thanks to their buyback program.
The share repurchases.
Exactly. That benefit basically offset the negatives, which were a higher effective tax rate this year compared to last. And of course, that lower adjusted EBITDA we just talked about.
So buybacks played a pretty big role in keeping EPS flat this quarter. Did they stick with their full year EPS guidance too?
They did, yeah. Still guiding to $9.10 to $9.30 for the full year adjusted diluted EPS. That assumes about a 23% effective tax rate and roughly 47 million weighted average shares outstanding.
Right. Okay, now let's tackle that negative $44 million free cash flow. Definitely needs unpacking. What was the story there?
Management was very, very specific on this. They said the main reason was purely timing of collecting cash receivables on 2 specific programs.
Just 2 programs. Did they say how much?
They did. They said it shifted about $75 million in cash collections out of the first quarter and into later periods.
$75 million. Okay, that explains the negative number. Did they say if they've collected it since?
Yes, and this is important. They said one of the 2 programs, they got the cash very shortly after the quarter closed, and they're making progress getting the cash from the second one. Crucially, they stressed this timing issue is not expected to impact their full-year free cash flow guidance at all.
And why the delay? Was it like a problem with the work that...
No, they were really clear about that, not related to program performance. They said it was down to new people and new processes at those specific customers. Think, administrative changes, bureaucracy on the customer side causing a temporary payment hiccup.
Okay, that's a really important distinction. Not a problem with SAIC's execution, just paperwork delays, basically.
Exactly. It kind of highlights that fluidity they mention in the government environment, even down to getting paid on time.
And despite that Q1 hit, the full-year free cash flow guidance is unchanged.
Absolutely unchanged. Still guiding to $510 million to $530 million for the full year. They even pointed out that works out to about $11 per share.
Wow, $11 per share in free cash flow. That's quite a bit higher than the $9-ish EPS guidance. Suggests strong underlying cash generation.
It does. They also gave some color on the timing within the year. They noted that this fiscal year, FY26, has an extra payroll cycle hitting in Q1 and again in Q3.
Ah, like a 3-pay period month sort of thing.
Sort of, yeah, for their biweekly cycle. Each of those extra cycles means about $125 million cash outflow in those quarters. So Q1 got hit by both that scheduled extra payroll and the $75 million receivable timing issue. That's why the number was so negative.
Okay, that makes a lot more sense. Explains the depth of the Q1 hole, but reinforces why they expect strong positive cash flow later in the year as the timing normalizes and the payroll impact smooths out annually.
Precisely. Lumpy timing, but the full year picture, they say, is still strong.
And speaking of cash, what are they doing with it? Capital deployment.
Well, in Q1, they bought back about $125 million worth of their own shares.
Okay, significant return to shareholders right there.
It is. And they kept their annual target for buybacks the same, $350 million to $400 million range. Plus, they mentioned they have another, call it, $150 million to $200 million in capacity. They could use that for small, capability-focused acquisitions, tuck-ins, or potentially even more share buybacks beyond that main target.
Suggests they feel pretty good about their balance sheet and cash flow outlook.
Seems so. They also made a point of saying they're actually ahead of schedule on their 3-year capital deployment plan, specifically on the share repurchase side. So, strong commitment there.
Okay, let's zoom out a bit. The overall business environment. How did they describe what they're seeing out there in the government IT and services market?
They said things seem to have stabilized a bit in recent months. The recent budget news helped provide more clarity on spending, which is good.
Stabilized, but maybe not totally smooth.
Right, not totally smooth. Still described as fluid. They pointed to high personnel turnover within customer agencies, especially in acquisition roles.
We hear that a lot.
Yeah. And that turnover, plus new processes being rolled out, that's contributing to those procurement delays we talked about, awards taking longer.
What about those government efficiency drives, the savings initiatives? Are those biting?
They said the net impact so far this year is, quote, nominal. They estimate the full year revenue impact is less than 1%. So not a major headwind for them right now.
And the president's budget request for FY26. How do they view that?
They saw it as, well, creating both opportunities and maybe some challenges, but overall supportive of their strategy. They sounded encouraged by the defense spending request, mentioned a proposed 13% increase if you include reconciliation funds, and they see ongoing political support for even more funding.
Does that defense spending favor certain areas or military branches?
Yeah. Based on the signals, they think the Navy, Air Force, and Space Force are likely to see stronger budget support. The Army may be a bit more challenged, but they feel their portfolio is pretty balanced across all 4, so they're positioned to handle those shifts.
And they kept emphasizing the type of work they do, right? Mission critical.
Yes, very much so. Highlighted the durability, mentioned holding up well through things like the DOGE audit scrutiny. They stressed they support a lot of the DoD's top 17 priorities, things like border security tech, missile defense, submarines, cyber, readiness, support for combatant commands, basically saying their work is essential, not easily cut.
Which ties right into that strategic shift they've been talking about for, 18 months now?
Exactly. Pivoting more towards mission IT and enterprise IT, they see that aligning perfectly with administration priorities, lethality, efficiency, and the push for faster tech adoption.
Did they have a recent win that sort of proves that point?
They did. They highlighted the Space Development Agency, the SDA. For Tranche 3, SDA decided to add a specific mission integrator role, which wasn't there before. SAIC won that. It's a $55 million cost-plus contract they booked in Q1. They see it as validating their expertise in mission integration and digital engineering right in line with their strategy.
What about the civilian side of their business? Similar story.
Pretty positive picture there, too. They said they see strong support across their top 5 civilian customers. That's over 70% of their civilian revenue. Mentioned opportunities at DOT, FAA, DHS. State Department, they just got a 2-year extension on the Vanguard program there. Treasury IRS tech upgrades and the VA's health records modernization. The takeaway was no major headwinds seen in civilian, plenty of opportunity.
Okay, let's talk pipeline and winning new work. Business development bookings. How was Q1?
Net bookings were $2.4 billion in Q1. That gives them a book-to-bill ratio of 1.3 for the quarter, so adding more new work than revenue recognized, which fuels future growth.
Any big wins in there?
Yeah, they mentioned a 5-year Army S3I recompete and an 8-year IT services deal for the Pension Benefit Guarantee Corporation.
And activity since the quarter ended.
Also strong. They said they've already secured over $2 billion in new awards after Q1 close. That includes that State Department Vanguard extension and a big new win with the Air Force. They did caution, though, some of these are still in the protest window, so might not hit the Q2 bookings number right away.
And proposals. Are they submitting a lot?
Yeah, Q1 submissions were $7 billion in value. They expect to keep that momentum going in Q2, and they're targeting somewhere around $28 to $30 billion in submissions for the whole year.
It's a big pipeline. What's their target for that trailing 12-month book-to-bill ratio?
They're aiming to get that back up to 1.2 in the coming quarters. They mentioned they have about $20 billion in awards currently pending decision, which helps support that goal.
But given those procurement delays they talked about, is hitting 1.2 in Q2 realistic?
They kind of hedged on that. They acknowledged the delays could push reaching that 1.2 target out by maybe a quarter or two. But, and this is key, they said even if some large awards slip, they don't expect it to materially hurt their revenue in FY26 or FY27, assuming things stay generally stable.
So enough work already under contract to keep revenue on track near term.
Seems to be the message. Their current trailing 12-month book-to-bill is 0.8.
How do they get from 0.8 to 1.2 then?
Well, they said the 0.8 is partly due to a really tough comparison against Q1 last year, which was huge for bookings. To hit 1.2 TTM in Q2, they figured they need about $3.5 to $4 billion in net bookings in Q2. And since they've already booked over $2 billion since quarter end, they feel they're on a good path to get there reasonably soon.
Any major known storm clouds, big losses coming up?
They said the only known recompete headwind of significant size is that NASA program loss from last year, and that should mostly finish rolling off in Q3 this year. They also reminded everyone about their decision to not bid on the lower margin Cloud One program.
Right, the Cloud One exit. How much revenue is that?
About $200 million annualized. They said the impact was in Q1, will be a bit bigger in Q2, then stabilize. Other than those two, no major known recompete risks highlighted.
I mentioned a protest too.
Yeah, a pre-award protest on one program, but they got a 6-month extension on the work, so no expected financial impact in FY26. They are keeping an eye on potential DoD budget shifts, especially related to the Army, but again, feel that portfolio balance helps manage that.
Going back to procurement again, beyond just delays, how do they characterize the environment now, maybe after things like the DOGE audit have settled?
Management felt the DOGE situation actually helped clarify the mission-critical nature of their work with customers. They really hammered the point that the delays they are seeing are mostly due to that personnel churn, especially in acquisition and new agency processes, again, not program performance.
And competitiveness. They're getting tougher.
They expect the mission IT space to stay competitive, sure, but said their historical win rates, which they claim are above average, are holding up. Procurements are still mostly best value, not just lowest price, though there's always some price pressure,
What about the continuing resolution, the CR? How's that impacting things?
They said it hasn't really slowed down solicitations, the RFPs coming out, but it is delaying decisions on the really big awards, like over $1 billion. They did say the CR feels a bit different, maybe more flexibility for customers than in the past. Near term, they're focused on driving growth from work already under contract on contract growth and said Q1 was solid there. Cautiously optimistic on seeing actual award announcements pick up soon.
And the DFAC memo, that push for more direct contracting by DoD?
Yeah, they addressed that. Their view is we're direct providers, hands-on keyboard kind of work, not consultants or just resellers. They feel audits and customer talks have confirmed that view. They also think their strategy, moving towards commercial models, SaaS, selling through marketplaces, that actually aligns pretty well with where DoD seems to be heading. So, bottom line, they don't see DFAC as a significant risk right now.
So that strategic pivot they started 18 months ago seems pretty well timed.
That was definitely the feeling they projected. Like the pivot to enterprise and mission IT delivered commercially, already happening now, just speeding it up. Focusing on differentiating in digital engineering, data, AI, secure cloud, expanding venture partnerships, all aligning with government priorities on lethality, mission focus. Sounds like they feel they're on the right track.
Okay, stepping back now. What does this whole SAIC call tell us about the wider government IT market landscape?
Well, it paints a picture of a market that's, found some stability after recent bumps, but still dealing with operational friction inside the government itself. The budget signals are key. Strong defense spending in certain areas is a clear plus, but you have to watch for potential shifts or headwinds elsewhere.
And those procurement delays, the personnel churn, things like DOGE, DFAC.
Yeah, those are big signals for the whole sector, right? It means success isn't just about winning the bid, it's about navigating those internal government dynamics. You've got to clearly show your work is mission critical and maybe adapt how you deliver, maybe more towards those direct commercial style capability provisions.
It really sounds like management's confidence in their own strategy is central to their narrative.
Absolutely. Sticking to guidance despite Q1 issues, explaining those issues as temporary, emphasizing the strategic alignment with government needs. It all points to how crucial positioning and balance are when priorities and processes are shifting. And that focus on contract growth, that's about operational resilience, delivering on what you have, which is vital in an uncertain environment.
What about that mention of fixed price contracts potentially being a tailwind?
Yeah, that was interesting. I wasn't saying everything's going fixed price, but the idea that for mature operators, outcome-based contracts could actually help margins. That's something to watch. If that trend grows, companies good at managing fixed price risk might see margin benefits. Definitely one to keep an eye on across the sector.
All right, that wraps up our deep dive into the SAIC Q1 FY26 earnings call.
Yeah, quite a bit to unpack there.
Definitely. And now it's time for our favorite segment. This is absolutely, positively not financial advice.
Crucial disclaimer. We mean it.
We really do. But let's imagine, just for fun, we're pitching an idea to a hypothetical investment committee based only on what we heard on this call. What's an outrageous but plausible trade?
Okay, I'm intrigued. Lay it on me.
The idea. Go big betting that the market is totally missing the story on that negative Q1 free cash flow and underestimating their capital return.
Okay, the thesis being.
The thesis is negative $44 million SCF. Looks bad, right?
Yeah.
But management drilled down hard. It was timing. 2 specific customer payments. $75 million shifted out of Q1, not performance. 1 collected right after quarter end, other being worked. And they reiterated full year FCF guidance of $530 million. That's like 11 a share. Massive positive cash flow for the year. Plus, they're ahead on buybacks, did $125 million in Q1, targeting $400 million plus for the year. That Q1 negative number, it's noise, explainable, temporary noise.
So the market might be reacting to the noise, ignoring the strong underlying cash story and the shareholder returns.
Exactly. So the outrageous play, go long, SE, like really long. But here's the kicker. Layer on some near-term call options, maybe expiring after Q2 results. You're betting the stock pops hard when Q2 shows the FCF bouncing back, or when they announce more big buybacks.
Okay, leveraged long based on a mispriced temporary issue. What makes it outrageous?
The other side of the trade. You simultaneously short a peer. The thinking is, if SEC is seeing payment delays due to government admin issues, maybe other contractors dealing with the same agencies are too, but maybe they haven't been as upfront about it. So you find a peer that might have similar but maybe less clear FCF timing risks, and crucially, one that doesn't have SEC's explicit explanation, strong balance sheet, and super aggressive ahead of schedule buyback program providing support.
Oh, the pair trade. Shorting a less transparent peer on the possibility of similar hidden issues while going long SAC based on their specific explanation and capital return clarity, that adds the spice.
Right. The plausibility comes from SAIC's detailed story about why Q1 FCF dipped and their confidence in the full year. The market might sell SEOC on the headline number, creating the entry point.
Yeah.
Shorting a peer without that clarity or buyback cushion adds the leverage. Totally hypothetical, of course, just connecting the dots from the call.
Got it. Not advice. But an interesting thought experiment based purely on their commentary, especially around that cash flow timing.
So, wrapping up this deep dive, SAIC seems to have started FY26 solidly, navigating, a still somewhat choppy environment. They feel their strategy shift lines up well with government needs, giving them confidence despite budget questions and procurement holdups. The Q1 cash flow dip seems well explained as timing, bookings momentum looks strong, and crucially, they held firm on full-year guidance.
Yeah, the main theme seems to be management's confidence in their strategy, their execution, their pipeline, and their capital returns, even while acknowledging those external bumps in the road like the Q1 cash timing.
And as always, this is just our take. To get the full picture, you really should check out the entire earnings transcript and documents yourself.
Definitely. The nuances matter.
And thinking about that $75 million cash shift, just customer admin processes causing such a swing in reported numbers, but not expected to hurt the year. Makes you wonder how much of the quarterly noise we see across companies is just that administrative friction, not fundamental performance changes. Something to think about.